Applying stock market mechanics. I'm Greg, one of the co-founders and COO of StockX. Very excited to be here today to talk a little bit about stock market mechanics, specifically how we leverage the method that a stock market uses to connect buyers and sellers to create a more powerful and more liquid marketplace. And hopefully there are a couple things in here, while many of them are very specific to our model and StockX, a couple things in here, both from the supply side and the demand side, that you can think about if for your marketplace business or marketplace investments that are relevant. This model, before we dive in, just to give you a sense of how it's worked for us, we launched StockX about 3 years ago and went from an idea to passing $1 billion GMV run rate last year. And a lot of that we attribute not just to having a great team and kind of good original idea, but to the power of this model. Before we jump in, a little bit about myself. I'm from the Detroit area originally, which is where we are based. If you haven't been to Detroit for a while, I would highly encourage everyone to come through. Perception, reality, very different when it comes to Detroit. And on the left, you see a picture of a Nextel phone. My background was in computer engineering. And for many years, I've loved building consumer products. And the first consumer products I've ever built were apps for these Nextel phones. That's really the only reason that's relevant. It also just makes me feel pretty old. The apps, by the way, when we launched on this Nextel phone, they didn't have an app store, so they put the apps in the ringtone category, which was not great for discovery, but now you know. The quick background on how we got to where we are from StockX for context. The guy on the left, not the most popular guy in the world in the Bay Area, but he is one of the other StockX co-founders, Dan Gilbert. And Dan was an investor in the prior startup that I was running. He's been a big force behind the revitalization of Detroit. And in early 2015, Dan approached me about this idea that he had been thinking about for a while around leveraging stock market mechanics. And when he started talking about stock market mechanics in his office on this Friday evening in early 2015, my initial thought was Robinhood already exists. We don't need another stock trading app. But then he started kind of quickly diving into the fact that he thought that this model that has been around for hundreds of years, right? This isn't a new model. It's been one of the most powerful forms of commerce for hundreds of years for traditional securities and commodities. But his thought was that this could be applied to other categories of consumer goods. So I said, okay, that sounds interesting. My background isn't in stock markets, but I like consumer products. And then he said, I think the first category we should start with is sneakers. Now, I'm actually wearing Jordan 1s today, but at the time I was wearing the same brown loafers that I'd worn for many years. So I thought he had officially lost his mind as he started talking about a stock market, now stock market for sneakers. It turns out there is a massive secondary market for sneakers. And this is one example of the type of activity that drives the secondary market for sneakers. A Jordan 3 on the left that has plenty of supply and would sell for $230. A Jordan 3 on the right that happens to be a collaboration with M&M and the Carhartt brand. Very limited supply, very high demand, $23,000. This was a new concept to us, but the coolest part as we started peeling back the layers of the onion was we realized that this model and this business, we could start with sneakers, but it could expand into many other categories. I'll talk about that in a little bit. And the only problem was we didn't have a sneaker guy. Dan wasn't a sneaker guy, I wasn't a sneaker guy. We had the stock market idea. We found this guy. As you can see, that's his closet. He was a little bit more of a sneaker guy than Dan or myself, and that's Josh. And the interesting thing about Josh was he was running a business at the time that would end up being the foundational layer of StockX, of a stock market platform, the data layer. Josh had created a company called Campless, which was a price guide. It was like the Kelley Blue Book for sneakers. He was mining eBay auction data, scrubbing the data, normalizing it, and had created this platform that people were using to look at the value of goods. And when you think about a stock market at the highest level, it is a value, you're showing value based on supply and demand. So with Josh on board, and turned out very serendipitously, he had a very similar vision of taking this price guide that he had. When we met him, he said, look, I'd love to let people build portfolios and eventually build a stock market. And we said, if you want to build a stock market, we want to build a stock market, this will work out. So we kidnapped Josh, we brought him to Detroit, and we've been co-running the business together ever since. There's going to be no audio, but this is where 50 Cent says, what the F is a stock market for sneakers? You can see him mouthing it there. It's a lot better with audio, I promise. Yeah, all right. So what the F is a stock market for sneakers? Let's dive into the model a little bit. A stock market is essentially a bid ask exchange. Buyers place bids, sellers place asks. When the bid and the ask match, an order is executed. Everyone's familiar with bids thanks to eBay, right? But in a stock market context, a bid is very different. On eBay, in an auction model, the highest bid is the one that wins, right? In a stock market model, a bid is essentially like a limit order. A bid is what is representative of demand. You could be the second bid in line, and you still end up having your order executed because the first bid expires, or the high bid, the order executes. So a bid, and in this context, is very different. We'll talk about some of the ways that a bid on StockX ends up being very powerful. You have the bid, which represents demand. You have the lowest, or the ask, which is essentially the seller's listing price, which represents supply. And then you'll notice in the screenshot here, you have a third data point, which is the last sale price. Those three data points together are what a buyer or seller look at to determine market value. On a stock market, and a securities-based exchange, you typically see, if you go to Google Finance or Yahoo Finance, you're going to see one price because the spreads are extremely narrow. When you're looking at it, when the spreads are a little bit bigger, when it might be a few dollars, the three data points that a buyer or seller need to be empowered to make a very smart decision end up being this bid price, this ask price, and this last sell price. Unfortunately, when we were early on, we wondered, would anyone understand all of this? But we're very happy that a lot of everything from 14-year-old kids to 50-year-old parents have been buying a lot of sneakers on StockX. So despite the little bit of learning curve, we've been able to get it to a spot where a lot of these users are understanding it. So this was going to be another video that we're going to show. I'm just going to fast forward through it, kind of walking through the mechanic. When you think about the categories that make sense for a stock market model, it's not for everything. So a lot of different marketplace businesses in this room, there are certain ones that a stock market model, pricing based on supply and demand, doesn't work for. If you look at the far end of this supply continuum, you have, we'll use eBay as an example, and that's a marketplace where it works really well if you have supply of one, right? If this is a product that you need to look at 50 different pictures of, the specific shirt that Roger Lee is wearing today, that item, it's been worn maybe 3 or 4 times, right? That one is not going to work as well in the stock market. It's a one of one. He's the only seller for that product. On the other side of the spectrum, you have Amazon, which is great if retail pricing works, which is when you have unlimited supply, right? If you have unlimited supply, plastic cups, paper towels, in that world, we believe in retail pricing works just fine, or wholesale resale. For all of these categories in between, you have finite amounts of supply. You have varying levels of demand, and it doesn't have to be extreme scarcity like that M&M Jordan shoe. But you have finite supply, varying levels of demand. And this is really just Econ 101. Supply and demand is a more efficient, more effective way to price those categories of goods. So when we look at which categories work well on StockX, of course, we started with sneakers. We've expanded to a few others since. We look at, does it fall into this part of the supply continuum? And then can you standardize the underlying good? Can you commoditize it so it's mutually interchangeable? And that means the kind of sniff test is, can we show a single product page that has a stock photo and allows you to buy this product because you know that it is authentic, you know that it's in the condition you're expecting. We create essentially a standard for each one of these things so that you can get to a single product page. Single product pages end up being a massively valuable, right? Just first of all, from an SEO perspective, we can drive all of this search density to a one page because we have a commoditized good, we have structured data, very different than the incumbents in the space, where for this particular SKU, you might see thousands of listings, right? Do I buy this one? Why is this one $200? Why is this one $700, right? It's mass chaos. It's extremely inefficient, very little liquidity. You also have all of the negotiation happening around a single product page, which was really helpful early on when we were trying to get the flywheel going. When you have one product page, a buyer places a bid, all of those sellers are going to get notified that a buyer placed the bid. Everyone's on one page. Everyone's negotiating around the same table. You only need one seller to respond, right, lowering their ask, and all of the buyers get notified. So today at StockX, we have millions of notifications flying back and forth for any one product page. And you think about how different that is from if, you put up one listing and you're waiting, hoping, please, someone come to my one page, but it's 20 pages down, and maybe you get someone that bids on that product, but again, there's only one seller. So there's a lot of advantages just at a structural level when you think about implementing the stock market model in its purest form. There are 3 tenets, core tenets that the business model is really based on: anonymity, transparency, and authenticity. And I'm going to hit these from bottom up. So first of all, on StockX, we authenticate every product sold on the platform. Roger in his keynote this morning talked about explicit trust. Used to be implied trust. In the world of StockX, we make sure that every product that ends up in a buyer's hands has passed through StockX and is deemed authentic, right? And this is critically important. If I'm not looking at what that product picture is and looking at all the details, then StockX has to stand in the middle to provide that explicit trust. But authenticity is not unique to StockX. The RealReal authenticates. There are plenty of other marketplaces that authenticate. So a lot of the value that ends up coming out of StockX sitting in the middle of the transaction goes beyond authenticity, right? It turns out us determining whether a product is real or fake, that was pretty important early on. But when people started realizing that we were doing this at scale, then they said, well, if I'm going to sell a fake product, I'll go to eBay or I'll go somewhere else where no one's checking. So the amount of product that actually comes through that we have a authenticity issue with today is pretty low. But it's everything else, right? Is it the right condition? For sneakers, this condition standard that we standardized around was dead stock, which means new, unworn in the original box. Is it the right condition? Is it the right size? Is it the right SKU? All of those other things that we're checking for. And now if you're sitting in the middle of a transaction like this and you have thousands of sneakers passing through each day, well, then we can control what the box and the experience and the packaging is that it goes out to the buyer so it's consistent across the board. And then finally, and this is something that we're just starting to get into, you can do really cool things around smart, intelligent routing of product, taking advantage of the fact that products are passing through StockX. We're dealing with commoditized goods. So if you have a seller on one side of the seller in California, and you have a buyer that seller connects with and is Europe, that seller sends the product to an authentication center in Tempe, and immediately we can break apart that order and reroute that package to someone else that's located closer. It can be based on distance. It can be based on who's been waiting longer for the product. There are a lot of really interesting things you can do from a routing perspective that a buyer never needs to know about or care about, but takes advantage of the fact that we're dealing with fungible goods and that we're sitting in the middle of the transaction. So all these things kind of compounding on the fact that the base component of that being providing authenticity. Next key tenet is anonymity. Anonymity, extremely important. If I'm buying a share of Apple stock, I don't know, and I frankly don't care who is the seller of that share of stock. It's irrelevant. I care about the value of the price. Is it going to go up or down? I care about all the things that I'm going to look at on again, Google Finance, Yahoo Finance, whatever data I'm looking at, but I don't care who the seller is. If I had to worry about the seller, and you're going to notice this theme, extremely inefficient, tons of cognitive overload, tons of hassle. On the supply side, when you're dealing with an anonymous marketplace, it levels the playing field. When Dan brought up sneakers for the first time a few years back, I went on eBay and I said, what would it look like to sell a pair of sneakers? And what I quickly learned is, I don't have any reputation. I didn't stand a chance. So I had to either accept the fact that my product's not going to move, or I had to drop the price so it was significantly lower than whatever somebody with 5,000 five-star ratings was going to sell for in order to be competitive, right? And again, imagine what that would look like in the world of traditional buying and selling shares of stock or commodities. If you look at that from just a data perspective, and this is a recent release, and we looked at a bunch of different data points from our platform compared to eBay, and what you end up seeing is, if you're a seller and you've had 1 to 10 sales, right, you are going to end up not having this extreme sort of pricing disadvantage that you would have when you have a seller that has more than 11 sales on eBay. Really what this just is doing, this is gouging the customer, right? This is saying, I'm going to try and take advantage of the fact that someone doesn't know that that's not actually the value of the good, and try to use my reputation to rip someone off. And when you have a level playing field, that dynamic doesn't come into play. And then the last piece here is transparency. A lot of times when you're building your company, you're thinking about your marketplace, you're thinking, well, all this data is proprietary to us. We need to use it to our advantage. We can't let anyone else see this data. We take a different approach, and that is one of absolute visibility. So not only do you see that bid price, that ask price, all the historical pricing data, but you can drill down on any one of those data points and see all of the underlying bids for this size 3.5 sneaker and the quantity available. And all of these things, now granted, if you just want to buy it, you can just hit buy, 2 clicks, you're out. But if you want to go deeper and really make an informed buying decision, you care whether or not there is a ton of bids at $320 or in that range, or if there's one and then everybody else is kind of bidding at $250. These are all really important data points. And what we found is transparency has allowed us to become the authority on pricing, which drives visits to the site, time on site. And today, we're pretty excited. StockX actually has more web traffic than footlocker.com and finishline.com. And it's because we have extremely transparent data set. If a sneaker is releasing, people are going to come to StockX or be on StockX as they're waiting online to see how the market is moving. And these are all advantages of having a very transparent and visible view of the market and providing that back to our buyers and sellers in an unbiased fashion. And this is very similar to the other chart, but essentially when you're dealing with a free market, you have pricing driven down for buyers. And if you're wondering, well, wait, doesn't that negatively impact sellers? Wouldn't they want to go here to sell for more, right? But the way this works, and this is again kind of macroeconomics of free markets, the buyers are going to go where pricing is lower. Supply is going to in turn follow the demand, and sellers are going to also go where there's less friction and more sell-through, which ends up sort of normalizing at a lower price point, and everyone wins. Lower price point for the buyers, more sell-through for the sellers. The most powerful piece of this entire product page for sellers, is I think we're getting almost out of time soon, is the sell button. On StockX, StockX is truly a two-sided marketplace. Sellers are just as empowered to execute an order as buyers. Everyone thinks of a marketplace, two-sided marketplace. That's how marketplaces work. But in just about every form of commerce, or every marketplace business we're familiar with, the buyer decides when they take the action to buy. There's always a buy button and a price. On StockX, it's a little bit unique that we've taken this stock market approach and have a sell button as well. And the way this works is sellers can go around all day long and just execute orders, accept bids. And our power sellers do this all day long. And from just a psychology perspective, right, as a buyer, I dip my toe in the water. I say, I'm not ready to buy this now, but I'll place a bid of $400 or $375. And then you're driving to work 3 days later and you get a notification you just bought the product, because a seller is just as empowered as the buyer to buy the product. So when we talk about sellers have more sell-through, sellers have less friction, sellers get more benefit even though the pricing is lower, this is one example of that. And just in closing, we've talked about this data layer. We've talked about this resell market layer. There's also sort of implications for the retail side of a stock market model. If you think about traditional stock markets, a company IPOs on a stock market and then shares trade, primary transaction, secondary transaction. So a couple years ago, we did our first IPO with its initial product offering in our case with Nike. It was a Cavs Court IPO, 46 pairs, where the market, the consumers, actually determined the price of the good. This was a more recent one. We did 800 pairs of a Ben Baller slide, which is a sandal. If you don't know who Ben Baller is, that's fine. If you see a $2 million chain that Drake's wearing, it's probably Ben Baller's. He was going to release these slides for $60 a piece, but instead, we did this as an IPO on StockX. We used a blind Dutch auction format. So buyers came to StockX, they placed bids, which was really just indicating, here's the price I'm willing to pay for this item. What ended up happening is the bids cleared at about north of $200, right? All the buyers were happy because it was a Dutch auction. The clearing price was lower than the price they actually bid. And the brand, of course, was happy because they extracted 3x the profit premium on this product, right? This is an IPO for a consumer good, and everyone ends up winning. There's no dealing with bots. There's no dealing with the chaos of waiting in line and fighting and all the hassle that comes from traditional products that release with scarcity. So you think about a stock market, you have the data layer, the resale layer, the retail layer, and then eventually a scenario where you buy that, you win that IPO, you get that product, and then you start moving that without ever even taking possession of the product. So just to expand the frame of reference of what this model enables, when you start to lay these foundational pieces, the opportunity is huge. So I know we're out of time. I'll wrap up there and hand it over to questions. Yeah.
Really like the presentation. Thank you.
Thank you.
So in the inevitability of the stock market, right, it gave way to frequency trading and arbitrage. Do you have open APIs? Do you see a lot of people that look to, or is there the capacity on your platform to buy and sell with a high degree of frequency?
Yeah, so right now we're dealing with this fundamental sort of matching algorithm or matching engine and focused on the resale side. But absolutely, I think that's the direction you go in, right? We sat down with a group of lumber commodities traders, and they're like, "Oh my God, if we could dive into this, to this platform, there's so much opportunity, to your point, to build businesses on top of this sort of unbiased live market." So we're actually, we've opened up the API to select developers, and we're looking to do more of that. But over time, I do think there'll be businesses that built on top of the platform, very similar to what you see in traditional stock markets. Yeah.
Do you think this could be applied to other verticals outside fashion? I saw some of the things you suggested.
Yeah, absolutely. I think that the characteristics, this finite supply, it doesn't have to just be things that sell for premium. Works the other way too. It's just a variable pricing model. The way we think about it is what makes, what's the sequence that you go after those other categories. But there's a lot of different categories. We have people say, you guys need to do this for banjos, or you need to do this for, whatever iPhones. I mean, so yeah, I think that fashion is where we started, and we've sort of built the brand around that. And we'll probably continue to add categories that are tangentially related. But eventually, yeah, this applies to a lot of different categories. Yeah.
You mentioned there was like a learning curve, and I have to imagine it's not very straightforward for a lot of people. Can you kind of talk through like some of the steps you guys took to kind of educate your users on how to use it?
Yeah, we spent a year trying to really work through the layout of just the product page itself, and where we ended up with, there's a lot of information on the page. But if you go to StockX, it's kind of hard to see in the screenshot, you see a buy button and a price. You can ignore everything else on that page, and everyone knows when there's a buy button and price what that means. So we early on tried to iterate quickly based on minor points of feedback. But because we kept this sort of a high-level construct of a buyer clicks buy, a seller clicks sell, we found that people picked it up pretty quickly and kind of ignored some of the other stuff. And then after they have a couple transactions, then they start diving into all the other things that the platform offers. Yeah.
When you commoditize all the items,
yeah,
that must have been a really tough decision, because you're probably getting rid of maybe half of the potential, maybe more, half of the potential shoes that could be in one particular kind of shoe.
Yeah.
How did you come about making that decision in terms of just quality, get rid of so many?
Yeah, so
shoes?
That's a great question. And that's why it was helpful to have Josh, somebody that knew a lot about the underlying market. And so some of the key points that went into that is, one, credibility. You want products in the catalog that are going to lend itself to that early adopter customer. But in our case, for sneakers, dead stock actually makes up the vast majority of the market. So you're also looking at where is there all the liquidity, and then you start there. There's nothing really preventing us from adding other condition standards. It's just that you have to have a standard. So in terms of where we picked the starting point, that was around liquidity and then wanting to start with the right level of credibility for that early adopter customer. Time's up. Oh, thanks everybody.